Hello, I'm Nicole and your instructor for this lesson. Welcome to this session on cash inflow and outflow. As you are aware, that an effective business has money flowing in, sources of finance, and money flowing out, costs. The difference is profit or loss. In this lesson, we will look at the outflow of money or costs and learn more about them. Let us get into it straight away. Did you know that a business's activities can also be described as an operating cycle? The operating cycle is the average period of time required for a business to purchase raw materials, produce goods, sell the goods, and receive cash from customers in exchange for the goods. To explain the operating cycle in simple terms, let us describe it in simple steps. In the first step, a business will purchase materials. These might be raw materials to produce new products, or they might be the materials used to provide a service. Or the business might purchase products from a manufacturer or wholesaler. This results in cash going out. This leads us to the second step, in which the business provides products or services to customers. The final step comes when the customer pays the business for the product or service, but the operating cycle doesn't end there. The business takes money it received from customers and purchases new products and materials, and so the cycle continues. You could also call this the money cycle. The business uses the money it has to buy raw materials or hire people, or to make products or provide a service. It sells the product or service to customers. Customers pay, and the business once again has money. Ideally, a bit more than they started with. It is essential that a business keeps track of their money throughout every stage of the operating cycle. In business terms, they must keep proper accounts of their costs, their revenue, and their income. So what do these terms mean? Let's take a look at this now. We have said that a business must keep track of their costs, their revenue, and their income. What do each of these terms mean? We are all familiar with the first term, cost. Cost is what a business pays. It is money going out of the business. The second and third terms, revenue and income, may seem familiar too, but defining them may not be so straightforward. You might ask, aren't revenue and income the same thing? In business terms, there is a difference. Revenue is the money a business receives for all the products and services sold. It is calculated before expenses. On the other hand, income is the money a business earns. It is the money a business receives minus costs. In other words, it is the business's profit. So why is it so important for a business to account for costs, revenue, and income? The decisions businesses make rely on information about costs, revenue, and income. For example, decisions about hiring new staff, changing a business's location, and choosing which suppliers to do business with will rely on cost information. On the other hand, decisions about how to maximize profits, as well as pricing decisions, and decisions on which products to withdraw from the market will rely on revenue information. Finally, decisions regarding the development of new products and services, paying dividends, or making new investments will be based on income, or on profit and loss information. The outcomes of these decisions will see a business succeed or fail. So the decision makers in a business need all the information available so they can make the best decisions. Let us go into these concepts in more detail, looking at them each in turn. We will begin by exploring revenue. We have defined revenue as the money a business receives. The most common source of revenue for a business is through selling products or services to customers, but businesses can make money in a variety of ways. Let us now look at revenue streams. A revenue stream is a distinct source of revenue for a business. To return to the furniture store from our previous example, we know that they sell furniture. That is one revenue stream. But what if they also perform repairs? That is another revenue stream. We see that this business has two revenue streams, furniture sales and furniture repairs. Let's look at some different types of revenue streams to give you an idea of what a business might do. Revenue streams are usually divided into operating revenue and non-operating revenue. Operating revenue, also called sales revenue or service revenue, is any revenue earned through core business activities, that is, activities which the business undertakes on a regular basis. For example, if a business is primarily involved in selling goods to customers, this is one of their core business activities. The revenue earned from sales is operating revenue. If the business also offers an after-sales service, which they can be charged for, this would be a secondary source of operating revenue. On the other hand, non-operating revenue is revenue the business earns without carrying out any activities to generate that revenue. For example, if the business owns premises that they do not use, they might rent this space out to a third party. Or if the business has investments, they may draw dividends. This would be both examples of non-operating revenue. So, now we know what revenue streams are and what sort of revenue a business might have. Why are revenue streams important? A business with multiple revenue streams has multiple ways of making money. If one revenue stream dries up, they can rely on their other revenue streams to continue bringing money into the business. Businesses can analyze the performance of each revenue stream individually. This allows the business to detect trends and identify unusual activity. For example, if a revenue stream with consistently high performance falls suddenly, the business will know they need to investigate that revenue stream in more detail to discover the reason for the change. By monitoring revenue streams, businesses can also make predictions for the future. Analysts can develop forecasts based on the patterns found in the historic data. This will assist with planning objectives and business strategy. Overall, when a business monitors their revenue streams, they are able to calculate their total revenue. Let us now look at how total sales revenue is calculated. When revenue is received for providing a product or service to customers, it is called sales revenue. Sales revenue depends on the price at which the product is sold and the quantity of products sold. So, total sales revenue equals price times quantity. You will see this displayed on your screen as an equation. Pause the video and take note. We will show a few equations through this session. Take the time to write them down. Welcome back. By estimating total sales revenue, a business can make better informed decisions about pricing and production. To give an example, let us return to our furniture store. Let's say that they predict they will sell 500 chairs a month if they sell each chair for £50. They predict that they will only sell 300 chairs a month if they sell each chair for £100. So, if they set the price at £50, they will make more sales, but let us calculate total sales revenue. 500 chairs sold, the quantity, times £50 per chair, the price, equals £25,000. But 300 chairs sold times £100 per chair equals £30,000. So in this case, the business would choose to price the chair at £100. They will make less sales, but they will have a higher total sales revenue. While we are discussing revenue, let's say a quick word on a relevant topic: cash sales and credit sales. When calculating total sales revenue, it is important to take into account whether the revenue received was from a cash sale or a credit sale. Revenue from a cash sale is available immediately, whereas revenue from a credit sale will not be. This will have implications for how a business calculates their revenue and how they allocate money to pay their costs. We will not cover the details of this here, but keep it in mind as you continue to learn about accounting and calculating costs, revenue, and income. So, we've looked at revenue and revenue streams in detail, but when running a business, there is more to consider than just revenue. For instance, what about the price of materials? What about rent, bills, and employee salaries? Without understanding the costs involved, a business won't have the full picture. So, we will now look at the topic of cost. We've looked at revenue and revenue streams, that is, money coming into the business. Let us turn now to costs, which we have defined as money going out of the business. However, we need to be clear on an important distinction. A cost is not the same as an expense. Costs refer to any money a business spends in the course of trading. Costs can include purchases of a product or service, transactions involving other elements of production or operations. An expense is a cost incurred on a regular basis during trade. Examples of expenses include rent, employee salaries, and utility bills. There is usually no asset or something of value associated with an expense. So, say a business buys a delivery van, the amount that is paid up front for the van is a cost. Now the business owns the van, they must continue to pay for maintenance, upkeep, and fuel. These reoccurring payments are expenses. However, to keep things simple for the purpose of our lesson, let us refer to both costs and expenses as costs, but it is important to remember the distinction. Costs can be divided into two categories: fixed costs and variable costs. First, let us define a fixed cost. Fixed costs are sometimes also called overheads. These are costs that stay the same, no matter how much the business produces or sells. For instance, rent is a fixed cost. If a furniture store sells 100 chairs one month and 1,000 chairs the next month, the rent on the office or warehouse stays the same. Of course, fixed costs can change. For example, rent might go up, but this is not based on the business's production or sales. Other examples of fixed costs include depreciation, insurance, interest, expenses, property taxes, salaries, and potentially some utilities. Next, let us define a variable cost. This is a cost that changes based on how much the business produces or sells. Raw materials are an example of a variable cost. The more chairs a business creates, the more raw materials they will need to purchase. So the cost of the raw materials will go up or down depending on the amount of products that are made. In other words, variable costs change in a direct proportion to a business's output. It is important to note that the variable costs involved in producing and selling a product or service are called the cost of sales. We will return to this concept later on in the lesson. Let us take a moment to look at another way costs can be categorized, as either direct costs or indirect costs. A direct cost can be linked directly to a product. For example, raw materials are a direct cost. A furniture business can directly track the cost of raw materials needed to create a chair. On the other hand, an indirect cost cannot be tied directly to a particular product. Rent is an example of an indirect cost. It isn't possible to link the cost of rent needed to create a product. Finally, let us consider sunk costs. This is a type of cost that cannot be recovered once it has been paid. Because sunk costs cannot be recovered, a business will not take them into account when making decisions. So we have looked at fixed costs and variable costs, and direct costs and indirect costs, as well as sunk costs. How does a business use these distinctions when calculating costs? To calculate total costs, a business adds fixed and variable costs. This is the overall cost that is spent on producing a particular level of output. Take a moment to pause the video and make another note. Welcome back. A business can also calculate the cost of goods sold, also known as COGS, by comparing the quantity of products sold to fixed and variable costs. Because fixed costs do not change based on the quantity of products produced, fixed costs can contribute to better economies of scale. For example, say a furniture store pays £2,000 a month in rent. If they sell one chair per month, the cost of rent is equivalent to £2,000 per chair. However, if they sell 2 chairs per month, the cost of rent is equivalent to £1,000 per chair. If 100 chairs are sold in a month, the cost of rent is equivalent to £20 per chair, and so on, as the amount of chairs sold increases. Now we have looked at both revenue and cost, we can move on to the next concept, income. Income, also called profit, is calculated in two distinct ways. either as gross profit or as net profit. Let us first look at gross profit. Gross profit is calculated by taking the total revenue and deducting the cost of sales. Here is your opportunity to pause the video and note this down. Welcome back. You will remember we mentioned that the cost of sales is the variable costs involved in producing and selling products or services. We also mentioned that overheads are defined as the fixed costs such as rent, salaries, utility bills, and so on. Since gross profit only looks at total revenue minus the cost of sales, it ignores overheads. But why would a business want to ignore overheads? The answer is simple. By calculating gross profits, a business can identify how much profit they have earned for each product or service they have sold. Returning to our furniture store, we saw they made £30,000 in total sales revenue per month. Our variable cost was the cost of raw materials, which came to £6,000. So the business's gross profit for the month is £30,000 minus £6,000, which equals £24,000. We also saw that each chair is sold for £100 and costs £20 in raw materials, so each unit sold brings in £80 in gross profit. Not bad. But that's not the whole picture. While it is useful for a business to calculate gross profit, they must also calculate their profits compared against all odds, fixed and variable. This leads us to look at net profit. Net profit is the money left over when revenue has been earned and all costs have been paid. Businesses calculate net profit by subtracting total costs from total revenue. Here is another opportunity to take note. Let us return to our furniture store. We estimated that they would sell 300 chairs a year at £100 per chair. 300 chairs a month at £100 per chair gives us £30,000 of revenue in a month. But what about costs? We also said that they paid £2,000 in rent each month. Let us also say that it cost the business £20 in raw materials per chair. 300 chairs a month at raw materials cost of £20 per chair brings us to £6,000 a month. £6,000 plus £2,000 in rent brings our total costs to £8,000. So where does this leave us in terms of profit? We have £30,000 in revenue and £8,000 in cost. Deduct £8,000 from £30,000 and we have our monthly profit, £22,000. Of course, this is an extremely simplistic example, for illustration purposes only. We haven't included any other revenue streams, and we haven't considered other costs like utility bills, employee salaries, or marketing costs. But it will serve us to explain what profit is. This leads us to the next topic, loss. We cannot talk about profit without talking about loss. As we said, profit is never guaranteed. When costs exceed revenues, when a business pays more money than it earns in revenue, that business suffers a loss. Loss is calculated by deducting revenue from costs. In other words, where total costs outstrips total revenue, loss is equal to total cost minus total revenue. Be sure to pause the video and note this down. Welcome back. Let us say our furniture store had only sold £10,000 worth of chairs in a year. We saw that their yearly costs were £18,000. So a total cost of £18,000 minus a total revenue of £10,000 shows us that the business has made a loss of £8,000. There are several ways a business can reduce losses. They might choose to cut costs, for example, by moving to a cheaper location or by switching to a cheaper supplier. They also might let go of staff. They might choose to increase revenue, for instance, by raising prices or by increasing promotional activities, to draw in more customers and sell more products. Woo! We've covered a lot in this lesson. We've looked at the operating cycle. We've covered revenue streams, looking at operating and non-operating revenue. We spoke about cash sales, credit sales, and calculating total sales revenue. We also looked at costs and expenses, including fixed costs and variable costs, indirect costs and direct costs, and how to calculate total costs. Finally, we covered gross profit, net profit, and loss. Take a moment to think about these concepts. Are you confident you have understood each of these ideas? If there is anything you need to revise, go back over the video. That brings us to the end of the lesson. Thank you for watching the video. Goodbye and good luck.